Hi, I'm George Dimov, the certified public accountant, and here we have Justin Ward. We're going to be covering a host of very exciting and interesting financial topics today. Justin's comment before we got started is, "Where are you located?" I'm actually in vacation with in Greece with my son right now. My son's an aspiring accountant, so I would have him kind of sit here and listen and get educated, but I want him to also explore. But that's enough about me. Justin, I really wanted to find out more about you, what you do, what your company does. And I'm interested, from A to Z. This next hour or 45 minutes or how much ever we want to spend, this is pretty much for you to showcase how can the strategies that you bring to the table or the knowledge you bring to the table or your team, how can they help our clients or anybody else that's listening to the show? So this is really what I want to focus on. To facilitate that, I have some questions, but we can stray off the question. So just to start, maybe tell me a little bit about you and your company.
Sure thing. So happy to be here. So Summit Financial Group is a sort of a comprehensive financial planning firm. We've grown to about 45 people, with about 18 advisors, and then a little over 20 support staff. And so the makeup of Summit is every advisor has the freedom to build their own practice. Within that, some of us are in teams, some of us are kind of doing our own thing, and each practice kind of focuses on its own little niche in the world. So, for example, we have one advisor that really helps focus on individuals that are going through divorce and post-divorce, helping plan for those types of scenarios. There are certain teams that we call them next gen. So they really focus on 40 and under, right? How do we plan for growing career, starting a family, those types of things. And then like my team, it's me and my partners, Don and Aaron, we focus on owners of privately held companies. So we help them through the growth period, exiting, what does Life 2.0 look like afterwards, and just kind of helping them through their own unique challenges and problems that they're facing.
Now, we bounced around some questions before, and one of them had to do with succession planning. And this is specifically, I'm going to ask about business owners, but we can also get into people that are non-business owners, but have a high degree of income or a high degree of stocks. So maybe go into one or the other, and whichever one you feel most comfortable discussing now, and we'll talk about any other one later.
Sure thing. Yeah, so when we're looking at succession planning through the lens of a business owner, we look at a couple things. We usually start off with, typically this is hopefully a few years before the actual transaction, is we want to focus on we always start with the individual first before looking at the business side of things. So we want to look at what does their financial picture look like? What is their lifestyle? What do they want their lifestyle to be in what we call retirement? Right? Typically, entrepreneurs go on to do bigger and better things. Typically, there's no traditional retirement, but we look at their lifestyle and we want to map out, okay, what is what we call a value gap for them? Like what number of assets do we need to get to after transaction so that they can live their desired lifestyle for as long as they live? And typically, that's done through a combination of things. One is the liquidity that we get out of the business in the meantime, right? The actual distributions, the cash flow from the company. And then depending on their lifestyle and where they're at, right, that kind of backfills into, okay, what do we need to transact at, right? Because a lot of times business owners look at, oh, cool, this is a $10 million transaction, $20 million transaction. But is that actually enough to live the lifestyle that you want to go live afterwards? And sometimes the answer is yes, sometimes the answer is no. And that helps us kind of frame the offers that they get. Can we accept this? Can we not accept this? And so that's kind of the lens that we're looking at it from a personal cash flow perspective. And then from a business perspective, when it comes to succession planning, it really depends on what kind of transaction they're looking to do. So if it is to the next generation, if it's to the kids, that's going to look very, very different. We want to get them involved in the business and making some of the management decisions way, way ahead of actually transitioning over the business. They want to feel confident that the business can continue to run and grow over time. If it's a management buyout, that can be a little bit more tricky. Which management is going to be involved in it? Can they actually run the business? Whose skill sets are best suited for those types of things? And sometimes it's one person. They know who it's going to be. They've been sort of training them up to take on this role. Other times it's not quite as clear. And then if it's for a third party, which typically results in the highest transaction price, typically a third party is going to pay the most for a business, then we're going to be looking at a couple different things. We want to look at one, who do you actually want to buy the business? Today, we've seen a lot of private equity money flowing in, right? They typically have a very different management style than, let's say, another company that just is in the same space and they just want to grow and expand. And so we want to look at it from that lens. And then also from the lens of, okay, what type of transaction do we actually want to do? Then we look at the actual business, look at the assets that make up the business. Do we want to do a stock sale? Do we want to do an asset sale? What's going to result in the highest after-tax net amount for the owners? And again, that's a little bit of a function of the actual business makeup and a little bit of function of what do we need to extract from the sale.
Got it. And Justin, one thing that I heard before you spoke about the business type of client, when we spoke about the personal type of client, you mentioned a transaction. Now, in the context of the W-2 employee that's a high income person that maybe has a few $1 million in equities or a few $1 million in liquid investable assets and maybe has a few million in real estate, for that person, when you said transaction, what can you give me some examples on what you're referring to or what that means in the context of things?
Sure thing. So when looking at a transaction, let's say just easy from a third party, that means we have an owner. Typically, it's been family run for a long time, and they're looking to exit the business. They don't want to run it anymore, but the business typically has some value to it. It is generating some cash flow, and somebody is willing to pick up where they left off and hopefully keep driving the business forward. And so somebody, either, again, another person, another company, or an investment firm will come in and give them an offer, sometimes unsolicited, or sometimes we will go out into the marketplace and try to get offers and basically see, one, who's the highest bidder, what are they willing to pay for the business, and two, does it make sense, right? Like I said, from a culture standpoint, sometimes we've had some owners that are like, I don't want to sell to private equity. I don't care how much money they give me. Okay, that's a good data point to go off of. So it's really just the process of exiting the business, transitioning it over to somebody, and they'll typically pay you upfront amount or an amount over time.
Got it. I see. So for now, you mentioned, and this is something I've been seeing this a lot. I'd say I started hearing about, I'm in my 40s, and I started hearing about this about 10 years ago, where maybe even longer, maybe 15 years ago, where there was this talk in just business, period, where people were saying the baby boomers are retiring. This is the time where private equity is coming in. I've noticed that private equity really comes in and works in a way, and this isn't a negative term, but in a way, bandwagons, where they choose an industry and they say, oh, we found this great industry that's going to be, I sat next to somebody in an airplane maybe a couple years ago, and she was involved in exactly that, buyouts, and she specialized in specifically blue collar related companies. Said she absolutely loves the space. This is what she does. And then I've seen even my own industry in accounting. I can't tell you, Justin, probably about once or twice a week, I receive an email from private equity, because now accounting firms are the new hot thing. Okay. And I've even seen this even on social media, like on Instagram, where there's whole courses on how to get your accounting firm to be great for a sale to possibly a private equity company. Can you tell me a little bit about what other trends you've been seeing? Because they tend to move in bunches. So I'd be interested to know what are the other bunches that are out there.
Yeah, for sure. So I think you hit on some big ones, right? Actually, a lot of our clients own heavy construction businesses here in the Bay Area and in California. And the amount of private equity money that has been thrown into those blue collar, more traditional type businesses, HVAC companies, those types of, it's insane. I mean, these people get offers every single week from a different private equity firm. You hit on another one, accounting firms, another one, even our business, right? Wealth management firms are big targets for private equity. The thing that I think that kind of underpins all of these businesses is a consistent revenue, right? Typically, they're very sticky clients, right? People that work with wealth management firms, CPA firms, some of these heavy construction, HVAC. It's the service model, right? It's very sticky clientele. You know what cash flow is going to look like next year. You know how to sort of drive the business forward, and that's what they like because they can model that forward, right? They have debt service typically. They usually don't pay cash for companies. So they like those types of businesses, I would say. A couple other big ones is dentistry, veterinarian clinics. Those are huge. Just in our area, there's probably been a slew of, like, even my dentist that I go to, it's been acquired by private equity. I mean, they are just throwing money at these different spaces. Again, because they're sticky, they're very consistent cash flow, and it's very easy to sort of model out, okay, if we do X, Y, Z, what is the EBITDA going to look like in 3 years?
Right. And some of the XYZ often has to do with operational efficiency.
Yeah. Yeah, 100% operational efficiency. And depending on the scale of the business, they acquire others around in the area, right? Because if you buy a company at, let's say, 20 million EBITDA, it sells for a certain multiple. If you can just double or triple that by sort of bolting on additional companies, then just keeping the sort of EBITDA constant, right? 20 million by another $20 million EBITDA, $40 million EBITDA company, it just gets a higher multiple because it's a larger business. So that's another way outside of operational efficiency, just the size and scale of these private equity firms, they can kind of drive the valuation higher.
Yeah, I noticed that. And some of the goal of these private equity firms, and even I've seen private companies do this with the goal of selling to private equity or to anybody. There's this whole concept, just like you said, all things held equal, even if everything just proportionally grows, you'll get a better multiple. And I think it's because when you see a company that's larger, people think of it more as a going concern, and the revenues, they feel more comfortable with the revenues. A small company is viewed at, oh, they only have this, or they're a one-trick pony, or they have one big client that if they lose, then that's it. But when a company has achieved a certain size, there's fewer of those risks. I think that's really what it probably is. What can you tell me a little bit about any kind of recent client? And of course, obviously we all have to maintain confidentiality, so you can change obviously any numbers or any facts or location, Bay Area or outside of Bay Area. So can you give me an example of any one client that's just somebody that you felt got a lot of value out of working with you, and what that looked like from A to Z working with that client?
Sure. So I'd say some of the most impactful work that we do are business owners that also have taxable estates. So what that means is currently the lifetime exemption is around $14 million a person. So for a couple, that would be $28 million. Anybody whose total assets minus liabilities are above that limit, they are now dealing with an estate tax issue when they both pass away. And that is taxed at 40%, which on some larger estates, that can be a pretty big tax bill. And so a lot of the work that we do that is most impactful is helping clients transition some of the business and some of the assets to the next generation ahead of time through various gifting and trust strategies. Like one impactful one that we've done is using something called an IDGIT, or an intentionally defective grantor trust. And so they run this business for a long time. They now have the kids wanting to take over the business. So they're starting to get them into management. And so what we said is, okay, what we want to do, transfer some shares of the company, not all of it, but transfer some shares of the company, which one allows us to do a couple things. If it's less than 50% of the shares, then they get valuation discounts. So that means it's discounts for lack of marketability, lack of control. And all that basically means is if you went to go try to sell this piece to somebody else, they would probably not pay as much for it, because they don't have the control over the business, the decisions, right? Somebody else owns 51% at the end of the day. So you get a little bit of a discount. And so when you gift those shares, let's say the business is worth $10 million. Let's say we gift 40%. Well, we would call that a $4 million gift, but because it's not a big enough piece of the pie, with valuation discounts, it might only count for $3 million gift. And so we can kind of help drive down how much gifting we need to do to get the same amount of value. And then with some of these trusts, like the IDGIT, the Intentionally Defective Grantor Trust, we can use 10% of that gift. Let's use the same example, $3 million. We can use $300,000 of our exemption, seed the trust with that, and then on the remaining amount, we can have a note. And so over time, you pay down the note. So that section of the transaction, that 2.7 million, isn't actually counted as a gift because you're paying off a note over time. And so at the end of this, whatever 10-year period, as cash flow allows us to pay down that note, we essentially transferred 40% of the business using only $300,000 of our exemption. Now, typically we would do this with larger numbers, but that's kind of a powerful example of sort of the different strategies you can utilize to help drive down some of those estate taxes. Now, why that is really meaningful is when you look out 20 years, right? These kids own a piece of the business, they will grow it. That $4 million piece of the pie will end up growing to $5, 10, $20 million. But from a estate tax perspective, that's not included in the value of let's say the parent's estate in this example. So they kind of sidestepped around that 40%. There is additional complexity there. Obviously, there is additional, tax filings, right? The trust has to file each year. Like there is some complexity to that. But for those folks that are impacted and have taxable estates, that can be really, really impactful when you look out 20 or 30 years and see, wow, we just saved a couple $1 million in taxes doing this. And it really wasn't that much work considering what they got out of it.
I like the name Intentionally Defective because in a way, the way the whole structure is set up is intended to impair the value at the time of the contribution in order for it to not get closer and closer to your lifetime exemption amount, the 14 million. Now, I guess in your example, and it's a simplified example, you used a $10 million valuation business contributing 4 million and it being really worth 3 because it's intentionally defective. Now, are there any situations where somebody can, because this is an irrevocable trust, right? Are there any situations where they would put more of their company in it, or maybe create a separate entity that goes into the trust? Or have you seen ones that are using various life insurance models for this?
Yeah, so that is another way that you can kind of mitigate some of the estate tax liability. There's something called an ILIT, or Irrevocable Life Insurance Trust. And so what you do is you typically buy a permanent life insurance policy because you need it to pay out when you pass away. You typically seed the trust with that life insurance policy. And the reason you want to put it into a trust is twofold. It's an irrevocable trust. One is at the creation, when you first get the policy, let's say it's a $10 million life insurance policy. You don't actually have to use $10 million of your exemption because it hasn't paid out yet, right? Like as it stands today, that policy is not worth $10 million. You can't go around and sell it for that value. And so you actually get a much more discounted valuation. Maybe use 100,000, 200,000 your exemption to seed the trust with that policy. And then from there, you can kind of do one of two things. You can either give to the trust each year to pay the premiums, right? Or sometimes we transfer some assets into the trust, and then the cash flows each year can cover the premiums on that. And the reason you have to do that is if, let's say I'm a parent and I have a taxable estate. This trust, when it pays out, goes to my children to help cover estate taxes, have liquidity, right? That $10 million can help cover part of the estate tax liability. And we don't have to go sell the family business. We don't have to go sell to private equity. We don't have to sell stocks when they're down, right? Unfortunately, there's not much leeway in when you owe that, and it can kind of be unexpected. So you have that liquidity there. But if I, as the parent, went to go pay that premium myself, then they would count that towards my estate because they're saying, well, you're paying the premiums, right? And so when I unfortunately passed away, that $10 million would get dragged back into my estate, and then I'd owe 40%, which does not make that very effective. And so the trust has to somehow, either I gift to the trust or the trust can cover the premium. That keeps it outside of my estate. And so that $10 million will not be taxed at that 40% rate. And it gives my kids a chance to use that money to, again, cover my estate tax liability.
Got it. And just for anybody that's listening to this, we have I'd say many of our clients are distributed very evenly along the spectrum of generations. And I've noticed that life insurance becomes interesting to people when they become older. And many of my younger clients, they often just aren't interested in any strategies that have a life insurance component to them. And it's just because sometimes people that are younger aren't thinking about dying right away, right? So what I'd say, one thing that people really don't understand about life insurance that would be good to clarify has to do with comparing life insurance in a way. And I'm not an investment advisor. Many years ago, I think maybe even 15 years ago or more, I had the licenses for all these things. But the, one thing that we should maybe talk about, and if you want, is just kind of this impression that people have about life insurance, that it's something that you're paying fees, and they don't really understand that whatever's growing in that policy grows tax-free during the time that it's growing. And we have many clients that are younger that are invested in equities, for instance. And there's policies out there that can mirror equities. And what's growing in there grows tax-free. And then at the time that the person passes away, it goes to their beneficiaries. And depending on how it's structured, there may not be a tax liability at that point. And the amounts can be staggering in terms of how much that policy may be worth at the time that the person dies. So, yeah. I mean, there's what do you say, and what are your thoughts for somebody that might be, let's say, just kind of a random client profile, young working professional, working in the Bay Area in technology, earning $600,000 per year, maybe late 20s, early 30s, and just no interest at all in life insurance products. Or let's say if you wanted to focus on business, flip the same thing, software as a service company with one single owner as an S Corp that is earning $500,000-$600,000 a year on a steady product, with selling the product and doing some maintenance work on it, that's earning that income. And how do you present them anything having to do with estates, trusts, and life insurance for that kind of person, where these are the kind of person that are most topic avoidant on anything having to do with dying?
Yeah, you brought up a really good point. I think the more millennials and Gen Z, they've definitely sort of been scared out of any type of life insurance, right? They've heard horror stories of people not getting paid out, or just paying really, really high fees. And they're like, I do not want to get scammed. I'm just going to stay away from it. But there is a lot of very, very useful use cases for life insurance where you're not getting scammed and you're not paying really, really high fees. I would say the most common thing we run into is typically young families, right? Maybe they just had their first couple kids, and we're like, hey, you guys have not built up a big enough asset base that if one or both of you guys passed away, you guys could take care of the kids. And, we think that you should get some type of life insurance. We think that would be a prudent thing to do. You are young, you are healthy. It will probably be relatively inexpensive to get a couple $1 million worth of life insurance just in a term policy. And a lot of people kind of hear life insurance and they think, oh, my money's locked up, right? I'm paying $10,000, $20,000 a year, right? These are the more like permanent life insurance policies, which there's many, many great use cases for those as well. But I think a lot of people fail to differentiate between the two, and they just see it all as one thing, when really there's lots of different types of policies, there's lots of different ways you can structure it, where again, relatively inexpensively, these people can be protected. But there's just this stigma from a couple different things. One is social media. I think really there's a lot of stories on there which scare people off. And then just in the industry, there's a lot of characters that maybe don't have the client's intention in mind when they kind of pitch certain products, and that can kind of give just the insurance industry as a whole a bad rap. And so I think that those two things really have kind of tarnished the name. And then the other thing I'll say about permanent policies, again, when we're talking about taxable estates, they can be really, really, really powerful. They do cost a lot more than term insurance, right? Sometimes these premiums, we have certain clients paying six figures a year in premiums for these policies. And when you see that on the front end, you're like, why would I ever do that, right? But then basically it's just a process of showing them, okay, what is the cost today? What does it cost over your lifetime? And what is it going to do for you and your family? Is it going to help you with liquidity, right? Some people, their major asset is their business, right? They don't have a ton of liquidity on the side. They don't have a ton of real estate. It's just the business. And so sometimes these are rather large 50, $60 million businesses. If they passed away, their kids would have to sell a portion of the company to pay the estate tax. There's just no way around it. And so in those types of scenarios, it's, well, would you rather have your kids be forced to sell the business, or do we need to start putting some things in place? Sometimes that's life insurance. And then when you kind of lay it out that way, they're like, and you really walk them through the numbers. This is what you're paying. This is what happens when you pass away. These are the taxes that you'll save. You don't need to sell the business. When you kind of spell out the domino effect, then they say, oh, wow, okay, like I'm now comfortable with it. But coming in on the front end, they just hear life insurance and they're like, no, thank you, I'm good. So I think those are the biggest detractors. And I think that, there's a lot of really, really good use cases for them. There's also a lot of really, really bad use cases for them. And so you just need to kind of make sure the person you're working with, or if you're trying to figure it out on your own, just make sure you really understand the products. Make sure you understand why you're getting life insurance in the first place. What's the purpose? What's the end goal? That'll kind of help spell out, is this a good choice? Is this not a good choice?
Got it. Do you guys at your group, do you work with any life insurance strategies directly? I mean, do you guys administer life insurance, or in a way get people in life insurance plans, or is that part of your planning portfolios of strategies?
Yeah, for sure. So all the advisors here have their insurance license. We help clients, but we're not product, focused. Like, we don't work with one insurance company. So whichever one offers the best rates, has the best terms, we'll go with them. I would say there's really two main types of people that we use life insurance for. One, it's the families that are still in build mode. They don't have the assets, right? So that's just basic term insurance. And then there's the families that are higher net worth that need that liquidity down the road. And so then we'll look at more permanent type policies. But again, like you kind of mentioned, those permanent policies typically will usually go with a variable annuity or a variable policy. And you can be invested in things like the S&P 500, right? Your money's not just sitting there locked up. You still are getting growth. You still are sometimes earning just as much as you would on the stock and bond side of things, while also staying protected. So they can be really powerful in that aspect.
On the on the life insurance, that can you give me? So I think that one thing that specifically our clients have would probably make it easy for them to understand, what are some life insurance products or ideas, okay, aside from the term, because for anybody who's listening, and I just happen to know this because many years ago I sat for these licenses, but and many of our clients are involved in this, so I overhear the conversations with their advisors, and we get involved quite often. But term is for a situation where, let's say, you have a mortgage and you don't want to not be able to pay off the home should one of the spouses pass away, and then you're stuck there with the bills and the children. You might not be able to afford it, so you purchase a term policy just for the term of the mortgage. It's a great example of that. And but the premiums are low, but once that term has ended, you've lost, in essence, your investment. And there's other products that are different in the sense that they kind of more mirror an investment that somebody is making towards some type of an end goal. And I think that in a way can be equated with long-term investing in a way. And again, there's no kind of pitch element to what I'm saying because I don't make money selling insurance. I'm just kind of throwing some thoughts out there. Do you sometimes think, or do you sometimes think that maybe a life insurance policy can be paralleled with putting money in the market? If the goal is money growth, are there any kind of plans that could achieve the same thing from a life insurance perspective, where you're invested in something that strictly tracks the S&P 500 in the same way that an ETF, such as kind of the SPDR S&P 500, tracks the S&P 500? Is there something like that on the insurance side that might achieve those same goals while doing it in a way that is tax efficient without getting 40% of your money taken for estate taxes? Maybe can you go into that a little bit? Is that something that maybe that can resonate with younger audiences sometimes too?
Yeah, sure. I would say the biggest use case that we've seen with those types of policies where you put in money via premiums, you can have it invested and growing. And to your point, it's tax deferred, right? On that growth, you're not paying taxes on that every year when the market goes up. I'd say the biggest use case are those clients we have, especially the younger clients, and those that still need their assets to grow, right? They're not at retirement, they're not financially independent. We still need some growth on the dollars, but they're very risk averse, right? They're not really as comfortable with the ups and downs of the market. They can't handle a 20% drop like we just saw in April, right? For those types of clients, there are certain insurance products that you can, again, track, like the S&P 500, for example, but then you also get protection on the downside, right? So in some ways it's market linked, but it's not exactly one-to-one on the ups and the downs. Typically you'll participate in the upside, most or all of the upside. Sometimes there's caps on there, but then you also have some protection on the downside, right? If you're down 10%, you're not actually down 10%, right? So they're sort of market linked, but they are for more risk averse investors, but we still need them to be invested, right? And this just helps them. This is just a sort of a behavioral technique to show them, hey, you can be invested, but here's the protections you have, but we do need the money to grow. So it's kind of just a way to kind of coach behavior and help them feel a little more comfortable investing for those that otherwise would kind of not invest their money.
Got it. So I've heard of that sort of thing before, where it's kind of an insurance product that maybe doesn't necessarily track the S&P 500, but also doesn't fall with the S&P 500. And kind of, I'd say, but you mentioned that there really are there any that follow? And this is something that I don't recall, I don't remember, I don't know. And I don't want to put you on the spot if you had to research it, but are there any products out there that do one-to-one mirror? I was using the S&P 500, but we can use any kind of basket of, the Russell 2000. I mean, doesn't matter. Is there anything that closely follows some type of index? Or that also, because you mentioned that it has to grow. Is that part of the requirement of what we're doing here, or can you explain that a little bit more?
Yeah, I would say in general on these insurance products, there is a million variations of them, right? A million different types of, okay, you invest in the S&P 500, but there's some sort of cap or there's some sort of downside protection, and there's a million ways you can vary it. But in general, I'd say the general rule is the closer you get to market returns, the more risk you're going to take, right? Those barriers start to kind of go away. So if you want truly like one-to-one market returns, you're typically going to have most, if not all, of the downside associated with that. And so it's basically a function of risk reward. The more upside you're willing to give up, right? Sometimes it's capped at 10% a year, or 12% a year, or 15% a year. The more downside protection you'll get. So it's very rarely, if ever, are you going to see you get the market return, but then you're also protected on the downside. Typically, you're giving up a little upside for that.
I see. Got it. Let's shift to kind of more traditional situations where somebody, and we get approached with this very often, Justin, and part of this, we work with people's financial advisor or CFP, their financial planner, or whatever job title they have, because there's many different licenses, and in a way, some of these fields overlap. I've seen cases where somebody says, "What kind of professional should I get for this?" I say, "Well, you can get a good estate and trust attorney, get a good certified financial planner, you can get a good CPA that specializes in this, you can get a good registered investment advisor that specializes in this. You can get somebody that's worked in one of those offices that doesn't have any of these licenses that knows a lot about this that can help you with this." So I see a lot of these kind of overlap situations. What happens when, do you end up working with a lot of clients, other professionals, and how does the overlap work? And maybe do you recommend your clients to work with more than one person? What do you do with this kind of soupy mix of nebulous ideas that a client might have, where there's no real one person that is going to do them, but they do need a comprehensive strategy? What do you do in that kind of case?
That's a really good question. I think it's kind of impossible to do the work that we do without collaborating with other professionals. I think the clients like working with us because they do feel like they have a team, right? They have a CPA, they have us. In some cases, they have an estate and trust attorney. And basically, they feel like we're all working together instead of in a silo, right? I feel like too often they get advice from this person, and they're like, well, that was different than the advice from this person. That was different from the advice of this person. I don't know who to trust, right? I think it is important that we typically start off with, okay, what's your financial picture? We think this route is best. And then depending on the situation, if it's a tax-related thing, is, well, maybe there are some unintended tax consequences that we haven't thought about. Let's go hop on a call with your CPA. Hey, can you run a tax projection? What do you think about this idea? Is there anything that we haven't thought of, right? And so the client's like, oh, wow, these people are talking to each other, right? I don't have to go relay back and forth, and things can get lost in translation. And so it's a very collaborative process. Same thing happens on the estate and trust side, right? We're like, well, we think this type of trust is best, or we think you should get this. But let's go sit down, and usually it'll either be on Zoom or in person. We'll go sit down in an attorney's office, and we'll say, hey, we're thinking about doing this. What do you guys think, right? It's just that collaboration and sometimes it's all three, right? If someone's exiting a business, you'll typically need all three of those, plus an M&A guy, plus, so it kind of is a very collaborative process. And typically on one thing, you could be working with 3 or 4 different professionals and trying to coordinate all that. But I think that's what clients find some of the most value out of the work we do, is like, we are a team, we work together, and they like not having to kind of run back and forth and try to figure it out and who's right, who's wrong. Because if you collaborate, usually you get to a consensus. Usually there's like, okay, we've talked it out, we think this is the best route to go down, and there's no question on, well, does this person agree, does this person not agree? So I think that collaboration back and forth is very valuable, and it's necessary. I don't know how you could do it any other way.
Right. Let's say you have somebody that's selling, that is entering a large transaction, or even just somebody that has a complex set of ideas that they want to test. Maybe they're looking to sell a particular stock. Maybe one thing that we've seen a lot, and something that I've, obviously I own real estate and stocks and bonds, but kind of, since 2017 or so, I've always had a little bit of cryptocurrency. And so we see a lot of this too. There's kind of this younger few generations of people that grew up with a computer, maybe not in their hand. I didn't grow up with a computer in my hand, but I'd say for over 20 years, I've always had a computer next to me. No, even if I'm traveling here and I have my laptop with me the whole time. So for generations like this, there's a lot of this kind of I can do it on my own mentality because so much information is at people's fingertips, like on ChatGPT. And I see people go down a rabbit hole of wrongness, wrong information on ChatGPT. And so I'm saying all this to say that for certain clients, and this happens with the younger ones, but sometimes the older ones too, there's a lot of price sensitivity when it comes to working with professionals in many cases. And I've thought about it before, what it might come from. It might come from kind of self-assurance that maybe I can figure this out myself, or maybe a lack of trust in the advisor, or maybe lack of perceived value. And you just described a few situations where, in theory, the business owner situation, for example, the person saved 40% tax on their estate. And this is a very tangible tax savings. And so people don't think about this final tax saving. They just see the upfront fees. And you mentioned that also on the insurance premiums too. How do you, when you have something that's in the best interest of the client, but you see price hesitation of whatever the setup fees are going to be, how do you typically address that in a way that helps the client help themselves?
Yeah, that's a good question. I think one, it starts off with getting to know your client really, really well. So most of our relationships, we start out with doing a financial plan, right? Before we ever manage money, before we ever talk about any of that, we learn everything about them. We put together a plan of this is what your goals are. This is how we think you can get there. These are our recommendations to just be in a better spot. By doing that, having all these conversations, we really get to know, okay, what is their personality? What do they like? What do they not like? And so I think it starts off with when you're giving the recommendation, one is there's usually a lot of ways to get to the same spot. There's usually more than one way to reach one goal. And so we like to give people a flavor of, you can go down this path and this is what it's going to look like. You can go down this path and this is what it's going to look like. This is what it's, 20 years down the line, this is the impact on your sort of financial future. There's no right or wrong. It's just, what are you most comfortable with, right? That fits you, your lifestyle, your personality. And when you kind of do it that way, it's kind of up to them, right? Another big thing is communication, right? You can have all the best strategies in the world. You can have all of these cool ideas and you can save this tax and that tax. But if you can't communicate that effectively, if you can't communicate what the process looks like, why it's so important, then a lot of people will have price sensitivity. They'll be like, I just don't get it. I don't get why I need to spend all this money. I don't want to pay these high fees. But if you explain it in a clear and concise way, they say, okay, I get it. It is a hefty price up front, but I see where it's going to get us to. And then it's also, like I said, what people care about, right? There are some clients that, one, don't have kids, or two, they're like, I don't really want to leave much to my kids. I'm okay paying the estate taxes. Like some people, they're not as sensitive to those types of things. And then you could pitch them all the cool strategies that you want. It's going to cost them $100,000 a year. They're like, I'm not going to pay it. And it's like, fair enough. But that's just, it's not important to them. And so I think it really just comes down to what's important to them, and also, do they see the value in it? And sometimes they don't. And I think these newer generations, mine included, they're very entrepreneurial. Like you said, they love to do things themselves, figure it out themselves. I think in a lot of ways that's really good. But I think in some ways they shoot themselves in the foot because they do it themselves and they think they know everything. In some cases, in a lot of cases, they don't know what they don't know. And they don't know that until they go talk to somebody, go talk to some professionals. And then they realize, oh, wow, I didn't actually know that. I thought I did. And so I think it's just encouraging them to speak to someone. And sometimes they don't need, right? Like we run into some prospects. We're like, you're doing everything right. Like, keep doing what you're doing. There's no value we can add here, right? And in those cases, it's like, if something comes up, if there's more complexity, if things change, come back and talk to us. But you guys are doing the right things. There's nothing that we can really help you with that would justify the fees.
Yeah, and one thing that I've thought about here is something that I've also noticed with the last couple generations is kind of a general distrust overall. Okay, and one of the ways that I'd say that one available way that I've seen that people are reaching out to find things that they trust is, you've probably seen this, especially over the last year, Reddit and personal recommendations. There's nothing like personal recommendations or other users' recommendations of a strategy. Now, all strategies are custom. So whatever strategy you're speaking with one client may completely not apply to another because of their risk tolerance, their liquidity needs, their time horizon, their personal preference, all these things that you kind of mentioned in some way or another earlier. I'd say and obviously there's kind of confidentiality protections against this sort of thing, but I've always thought like there should probably be some kind of way where especially in your business, if you're working with one client, this is kind of a way to speak with their associates and people that they know, where you say, look, we've been able to accomplish this strategy and you're happy with it. Let's go ahead and speak with some other people that can take advantage of this in your own network. Because I feel like in these last couple generations, and probably even before, I think this is kind of in all of history, people have really trusted things that are coming through people that they know, not just somebody that they view as, oh, they're looking to sell me a financial plan, or they're looking to sell me a product, or they're looking to make money off commissions if it's an insurance product, or if you're establishing an estate or trust structure, whatever fees that the client is paying to set that up. They may start thinking, oh, this person doesn't have my best interest in mind. I think through a referral, in a way, kind of using referrals or using interpersonal relationships probably is a better way to get the word out there. And it's, especially with things that have a stigma, like the life insurance or any insurance product has a major stigma. What do you think about that?
I think that you just spoke to one of the reasons that like 90% of all financial advisor clients come from referrals, right? It is a very trust-based business, right? You are talking sometimes about things that you would never speak to about anyone else, even certain family members, right? It's a very personal business, and they're putting a lot of trust in you in some cases, right? These are once in a lifetime decisions, right? How do they invest their money? How should we sell the business? Like these are things, there's no do-overs, right? You either get it right or you don't. And so that's a lot of responsibility to take on. That's a lot of trust the clients put into you. And I don't think you build that through an advertisement. I don't think you can, through a social media ad, like you can't build trust that way. One of the big ways you can build trust is with your clients, and then they have that trust and they say, look, I really, really trust this person. They've done a really good job. They've done X, Y, Z. I think you're dealing with some of the same issues. You should go talk to them. That's how most clients come to be, and it makes sense because this is a trust-based business. Just to speak on your point about Reddit and social media, just getting advice from other people. I think there's a lot of good information out there, right? The internet and ChatGPT has done a really good job of bringing information to people, but not all of it's accurate. And when you're dealing with money, when you're dealing with taxes, there's a very low margin of error. And one detail that's wrong, one wrong piece of information can completely change the outcome of what you're trying to do. And so if you think you have your own plan, or if somebody on Reddit or ChatGPT tells you this is what you should do, it might be 100% accurate. But I would always go run it by somebody, right? Go run it by your CPA. Go sit down with a financial planner. Even if you don't plan on having a long-term relationship, if you don't plan on hiring them, right? Just pay them for an hour of their time, whatever it may be. Just get a second set of eyes, because somebody who does this for a living can very quickly look at that and say, nope, that's wrong because of this and this, and that's completely illegal actually. And there's just so much misinformation out there. Like the amount of times on social media or even LinkedIn, I've come across posts and I'm like, that is just straight illegal. That is just, you can't do that. But they sound confident and it sounds good and save them much money in taxes. So
Oh yeah, I see those too. From the tax side as well as other things that I just happen to know just because they overlap with tax or business. Where I say to myself, I'll see it on social media and say, no, that's actually incorrect, and you'll probably get in trouble for that. But yeah, I think that in the tax side, on my side of things, my practice is focused on tax and tax planning and tax strategy, and also other kinds of things that businesses need, like audits and things like that. This is heavily trust based. This is heavily, and I'd say a big part of kind of the reason that people use us is what somebody else has said. And so I agree with you that anything having to do with financials is just difficult to trust. And I think that that's a holdup for people for a number of these strategies that we talked about. One of them is for those that lived through the financial crisis. Can you really trust your insurance company with safekeeping your assets? I mean, I think the government had to come in a way save American Insurance Group. At the time, I think they were the world's largest insurance company. And I think the government came in and at the time had to save them. Later on, we found out that these assets that they held in their books were actually, worth something. And I think the government ended up making money on that investment. But there's some distrust there. And there's another place where there's distrust. When you think about an irrevocable trust, I mean, when you work with clients on this, how do you address this particular aspect? Do clients usually approach you and they already know exactly who's going to be the designated beneficiary? Or is this something that's more of a kind of an open conversation? How do you address that?
Yeah, I think it can take a long time to get this right when it comes to gifting, when it comes to estates. Typically, it's 6 months to a year when we're working with someone before we actually end up doing anything, because these are, again, irrevocable decisions. They're irrevocable trusts. You can't just say, never mind, I don't want to do that. And so it is really a process. And sometimes they have a really clear idea. They're like, yep, I know exactly. It's going to this person. I want them to have it at 35 and I want them to have it at, but most of the time it's not that. I haven't really thought about it, actually. I don't know when I want them to get the money. I don't know if, this person, let's say in my business actually, or this really close person to me, it's not a kid, but like, I still kind of want them to have something. I haven't thought about how that's going to look. And then there's a lot of family dynamics. Like that's like most of it is just family dynamics, right? Especially when you're talking about succession planning. It's like, I have 3 kids. I want them to be, treated equally, but one of them I think is capable of running the business. I don't think the other 2 are. How do we how do we make this right? We can't have 3 CEOs, and I know one of them is just better equipped for that. Or, sometimes you have one kid that's a lot more responsible, other times another kid that's not so responsible. How do you deal with these things while still making it fair, still making it equal, and not, when you pass away, have the family fall apart because there's all these, somebody's upset about something. So it's a lot of conversations. It's a lot of honesty, right? A lot of conversations that you never had before, right? Especially when you're talking about like trustees, right? You have to pick people to manage the assets when you're gone, or if it's an irrevocable trust, even when you're still here, sometimes you need another trustee. You can't be the trustee for certain reasons. Picking somebody to do those types of things that are handling your assets. Sometimes the trustee has discretion. Let's say it's passing down to your kids. Sometimes it's, okay, your kids get everything at 50, but until 50, the trustee has discretion on if they think the kid is responsible, if they need money for a good reason. Like, you need to pick somebody who you really, really trust. That's a really big responsibility. And again, it's just conversations, and a lot of times it's multiple iterations, right? It takes a long time to get this right. And I think more often than not, and sometimes we bring the kids in, right? It's a whole family conversation. And those are really the most impactful ones, because we kind of help lead the next generation instead of just, hey, here's a bunch of money. Let's talk about it. Let's talk about how to manage the wealth. Let's talk about, how you feel about money. Let's make this a family conversation. And I think those are usually the most impactful ways of doing it. If the parents are comfortable, if it's the right circumstances, is having the whole family in and having conversations.
Yeah, I think that's a good point. I've seen even in very basic routine administrative things where we're preparing a tax return, and you can just tell that there's possible issues with the relationship between some of these people that are involved, where they're brothers or sisters that may not be speaking with each other, or just other complexities in the relationship. And I think that I do think that honesty is the best policy. And I think that that's with life as well as in business. A lot of these things that we're talking about here are really life things. And I think a lot of these conversations are difficult for people to have, because you mentioned something, Justin, that it really stuck out at me, which is this is the first time that some of these questions have been even brought up. Maybe I was going to say addressed, but maybe they didn't even get addressed. Maybe they just, right? Some of these may be ones that people want to avoid. I see this in my own work. When somebody has a complex situation, or they know they're going to owe a lot of tax, sometimes those are the exact clients that wait until the last minute to file an extension, which is the exact kind that really should be planning far in advance, because sometimes it's something that so complex, and it may feel so complex, and that it may feel overwhelming, or it just may be a difficult conversation. Some of these are conversations that I've talked with staff members of mine where I say that we're talking about using other professionals. Does this person need us, or do they need somebody to talk to that's not in financial service, like is in, just somebody to talk to? Sometimes there's situations where there's things that we can't really necessarily fix or help with, where the client or the prospective client needs to really, kind of think about what they want to do. And you probably see that in the forefront even more than we do. I'd say a lot of our work is planning, but we do a lot of your kind of routine preparation. So you probably see this even more than I do. I mean, that's probably why it takes 6 months to do something with some of these clients. Is you're still kind of going back and forth.
Yeah,
Are there situations where the person just walks away? I mean, what do you do?
Most of the time the answer is no, but there are some cases. I would say a lot of what we do is in some ways therapy, right? As much as we have the technical strategies and the investments, a lot of it is coaching. It's behavioral coaching. It's trying to get somebody to do the next best thing, right? And sometimes that's really hard, right? We've had some clients come in, they're making good money, but they just can't stop spending it, right? They just don't have a plan. They're not, maybe as disciplined as they should be. They're behind on tax payments. It's like, you made $1+ million last year. Why can you not pay your taxes? And the answer is not some outside circumstance. It's usually just behavioral management. And those are tough conversations, right? It's a tough conversation to say, look, if you don't address this sooner than later, you will be working until you're 80. Like, those are really difficult conversations to have, but I think they're necessary, and you have to approach them with empathy and grace. But at the end of the day, these are not easy conversations, and I think most people appreciate the honesty, even if it's hard to hear it. But there are some times, like just recently, there was a prospect that came in. He was quite wealthy, but he sold his business. He didn't plan well ahead of time. He locked up some money in irrevocable trusts in certain different real estate projects that needed to put more money in, and he was retired at that point. And he just bought a multi-million-dollar house. And just all these things came together at once, and then he felt wealthy. He just sold his company, and we looked at it and we told him, you're going to run out of money in like 3 years. Like, this is not a good trajectory. And, we did a lot of analysis for him. At the end of the day, he didn't end up working with us. I think, those are conversations that are tough to hear. nobody wants to hear you might have to downsize your home and you might have to do this and that. But you owe it to clients to be honest, and you just got to do it the right way.
Yeah, I think that's really tough. Yeah, I've seen that. One thing that I've seen in my business, Justin, and I'm sure you've seen this before, is success in business or even in careers may be a temporary thing. And many of us will have careers where it seems like just each year we just make more money. And it's like almost like a given. I'm going to make more money. But it doesn't always work that way. And depending on how many things somebody's tied up in, I was reading a book called Scaling Up by Vern Harnish, which talks about the financial portion of this book is really interesting. It's at the end, and they don't spend too much time on it, but they break down basics. And one thing they break down that's very interesting that I really don't see in many places, this specifically for business owners, but can be applied for people's individual situation, is other than looking at assets like cash or stocks or real estate, other than looking at what your net income on paper looks like, do you examine what your cash flow looks like? Because net income from a business perspective or from even a wage paycheck perspective, and assets that somebody might have just kind of on a balance sheet or a personal statement of net worth, they'll show a limited picture. But if you look at somebody's actual cash flows from beginning to end, are they increasing in cash, or are they decreasing in cash? Or better yet, what has been the trend of that over the last 2 or 3 years? That can be tough, because sometimes people's spending may hit a point where it starts to grow faster than their income, and they might not see that point. And that book gave an example of an entrepreneur that didn't see that point, but their bank caught it before they even caught it themselves. And so I'd say I'd say when you see this kind of situation, and you're having the tough conversation with the client, when you propose a strategy for them, okay, what kinds of things can you do other than, hey, your spending is just growing out of control? Are there any other things that could be done for that individual? I mean, what do you think?
Yeah. I think it's obviously very situation dependent. One thing we want to look at is obviously discretionary income. Like, what is it that's necessities, and what of it that is just for fun? Obviously, that's the most basic example. And then what are some things that you've kind of agreed to in terms of debt, right? Is there a way to renegotiate that? Is there a way to maybe pay something off, right? So we want to look at those types of things first. And then outside of once we clear the big hurdles, like, okay, maybe we want to refinance something, or maybe we want to knock out this loan before investing more money. Outside of those big things, I think a lot of it is just getting them on a right track from that point forward, right? Some of the things that, maybe there's daycare, maybe there like some things you can't get out of. But one thing that we really highly recommend is figure out what you need to save annually or monthly or quarterly, and have that go on autopilot, right? Have that just get taken out of your checking account, right? Maybe when you have a distribution from the company, if maybe once you get every 2 weeks, you get your paycheck, whatever it may be, just have that go automatically, because people tend to spend what they see, right? We see that with lotto winners all the time. They get a bunch of money, their lifestyle goes out of control. So I would say put that on autopilot, figure out the big stuff first. If there's any debt issues, if there's any crazy spending lifestyle stuff we can cut back on. And then after that, it's just behavior management going forward, right? How do we put things on autopilot so it doesn't take the willpower, it doesn't take the discipline. It's just boom, boom, money gets put into your brokerage account or an account for paying taxes for those people that have issues, keeping money on the side, right? We see that with business owners all the time. They're not, or especially new business owners, they're used to having their, taxes withheld. They're not used to having to keep money on the side for that, for quarterlies or what it may be. So I think it's the big things first, and then behavior management. Try to autopilot as much as you can so that you don't have to think about it. It just happens automatically.
Yeah, I really like that people spend what they see. And I agree with what you said about the quarterly taxes or setting aside taxes. And this doesn't only apply for business owners. This applies for high income wage professionals that receive, or ones that are on 1099, or anybody that's receiving large bonuses or large stock payouts. Sometimes they're not even,
apparently I
they don't even think about the tax because they're so used to it, coming out automatically. And one thing we have to explain to people, now that your employer isn't taking this money out or not taking sufficient money out,
while recording,
you have to do it yourself.
But you can't switch cameras.
Like you have to do it. You actually have to do it yourself, the same way that it would be if you were still working with your employer. And it's very hard to bridge that because I'm not working for you. It's like, I have to pay tax. I never paid tax before. Is it? Yes, you did. You just didn't see it. You just didn't see it. You paid the tax before. You just didn't see it. So it's very difficult when it's them clicking on the mouse with $200,000 going to the IRS on, the September 15th quarterly tax deadline, because it's not something they've ever had to do before. So I guess the final topic, and it's the only one that we didn't cover I looked a second ago on the sheet. If there's anything that we kind of had a list of just very rough topics to talk about, and one of them that we haven't talked about is kind of this traditional, just kind of equities, and kind of going off what we talked about, and this isn't even only a younger generation thing. I've seen older clients say, well, I've been doing this for 37 years, and I know what I'm doing. And I've heard this the thing about 37 years a million times. I've been doing it 37 years. So when somebody's in that situation and they have a strategy. I buy the dips, or I do dollar cost averaging, and I use, I sell any losing assets before year end, and just kind of do all the basics themselves. Maybe they even are sophisticated and they sell some call options on certain investments that they're confident they have a good feeling about the direction of them and things like that, and make some extra option income and tend to just be involved. Do you even say anything to them about the value of working with somebody if you're going to focus specifically on just the equity portion of their portfolio? I mean, what do you think about that?
I think in a lot of ways, ETFs and passive investing can work. It can work for a lot of people, right? I mean, you look at a lot of mutual funds and actively managed funds. A lot of them cannot beat the market. That's just a fact. Some of them can, but a lot of them cannot. And I would say to those people, one, we are not hedge funds. We are not private equity. We're not going to guarantee we can beat the market. That is not our value proposition as financial advisors. Some love stocks. They're good at it. That is the value they provide. We don't share that same philosophy. We think the value that we provide is behavior management. It is in some of the making things tax efficient. It is with some of these other strategies, right? Taxable estates, with the insurance planning, with, I already touched on it, but behavior management is huge, right? The amount of people that do it themselves, but then they kick themselves in the foot because they don't rebalance, or they try to time certain things, and that usually doesn't end well, right? I think Vanguard did a study. People that try to manage their own investments typically perform 4 to 6% worse than those that just kind of leave it alone. I think that kind of speaks to a lot of what we do is coaching people. Hey, stay invested in the market. Now is not the time to sell, right? We had a lot of people calling when the market was down in April, right? The world is ending. We have to move to cash, right? A lot of what we do isn't like trying to beat the market. It's just keeping people invested in the right things and keeping them on course. So yeah, that would be my sort of answer is yeah, a lot of these people think financial advisor, they're stock pickers. I don't think they're going to be the S&P 500. That's probably true. But I think there's a lot more value to be provided. And some people are really level-headed investors. They have their head on straight. They can stay focused. They can stay disciplined. And to those people, yeah, the value is slightly less, or at least on the investment side. Not all the other stuff, but on the investment side, right, you can do very well just passively, right, buy IVV, buy certain indexes and just let it ride. But for those people that want a little more complexity, they want somebody having an eye on things, right? Some of these professionals you mentioned, they're busy. They don't want to think about asset allocation. They don't want to think about these things that's, they have enough keeping them up at night. I would say that's another value is not that we're necessarily going to beat the market, but we're keeping an eye on it. We'll make sure that you are in the right places, and just kind of take that emotional baggage off of people. I think that's another big thing that is missed when people do it themselves, is how much stress that can end up causing when it doesn't need to.
Yeah. I mean, I agree with you. Yeah, about the specifically about the stress. If it's somebody that the person trusts, in a way, maybe they don't have to look at their portfolio all the time, right? And when there's market downturns, this is when people panic sell, and this is exactly when many people say you should buy. But you're right. There are some people that are very well financially educated and may not even need you guys specifically for that particular portion of their financial life, but would find tremendous value in the tax savings portion that they might not have that are doing their taxes themselves. We have many people that use us for guidance that are doing taxes themselves because their taxes are so incredibly simple, and that they need some guidance on maybe estate and trust matters, maybe other things. So, for clients like that, I would say don't write off an investment advisor because you say, oh, I know how to manage my own stocks the best. Like you said, you don't know what you don't know. So I'd say with anything like this, it never hurts to have a conversation. So if any client of mine is listening to this, or if anybody else wanted to contact you, what's the best way to do it? Is it by email? And we'll put your email and web address and a phone number later. But what's the best way to get a hold of you? Is it to shoot you an email, or what?
Yeah, the best way is to shoot me an email. I'm sure it'll be somewhere on screen. Typically we start off relationships with an informal conversation. Like I said, sometimes people are doing things right, and there's not enough value to be provided to warrant a long-term relationship. So we'll give them some tips, and we'll say it was very nice to meet you. Other times we see sometimes big issues that we think that we can help provide value, but you can't do that without having a conversation, right? So we're always happy to just have those and just bounce ideas off of.
Awesome. Yeah, I'll put both of our information. I'll have my assistant put both of our information under the video, so anybody here can reach out to Justin, see if there's a fit, what kind of fit there may be, what kind of ideas his team can bring to the table. Same thing applies for us. If you have ideas you wanted to bounce off of any staff member on my team or myself, feel free to ask those. You can direct message us. You can email us. Whatever way is the one that you feel most comfortable. And that's basically the best way to start a relationship is have a conversation, see where there's a fit, if there's a fit. And but yeah, it was great. It was great having you on here, Justin. Super appreciate you taking the time. I think we covered a lot of things. We covered a lot of things that I've never really spoken about with any kind of professionals publicly, like things that we see as kind of people's advisors. Certain mental and psychological things that we see as people's advisors that usually don't come up. So it was a lot of fun doing this, and again, anybody wants to contact us, our information will be below. And it was great having you on the show.
Thanks for having me. It's been fun.